Hello, everyone, and welcome to the December 2022 monthly market update. We're actually going to be using this as our 2023 outlook. And within this outlook, we have a couple of things that we're going to be keeping an eye on throughout 2023. Specifically in the new year ahead, we do believe that rates will be lower as inflation trends lower. We do think corporations will cut costs, which should insulate them from some of the growth headwinds that we anticipate for 2023. And we believe that demand from the consumer standpoint will likely slow. However, we do see that it could pivot in the second half of 2023 as well. So let's get into some of the details as to why we think this will happen throughout the course of the new year. So lower rates on lower inflation. We've already seen inflation come down quite materially from its peak earlier this year. However, the Federal Reserve is likely to continue to hike rates throughout 2023, or at least in the first half, as they try to advance their overnight rate closer to that 5% terminal rate, as they've outlined in the dot plots here recently. Now, they will begin to focus on the evolution of restrictive policy throughout the year, looking ahead into 2024. However, that's under the assumption that inflation continues to trend down as it has been. We don't think it's going to be a clear linear lower trend. As we've seen already, inflation has bounced around a little bit, and there's a lot of factors that go into it. But at the end of the day, inflation has been trending lower, specifically on the goods side of the category. Services is a little bit more sticky, and we'll get to that in just a minute. But as restrictive policy from the Federal Reserve standpoint continues to take hold throughout the economy, we do think it's going to slow down throughout 2023. And as it slows, if inflation continues to trend lower towards the Federal Reserve's target, closer to 2%, you may see some dissents within the Board of Governors for the Federal Reserve, suggesting that restrictive policy may remain tight throughout 2023, but they may want to see it start to come down at the beginning of 2024. So the Treasury market, or government bonds, is likely to anticipate this, especially if we see those dissents start to build within the Board of Governors for the Federal Reserve, and yields will likely come lower, which should bolster stock prices. And if this all happens, we do believe the Federal Reserve will likely cut rates, perhaps not at the end of 2023, but more likely at the beginning of 2024, especially if we see inflation trending towards that 2% rate. Now, corporations are going to be all in the middle of this as well, and they're going to have to batten down the hatches a little bit in order to weather whatever economic storm gets cast as a result of this restrictive policy. So we've heard a lot anecdotally about corporations and the supply chains beginning to normalize, especially for those companies that produce a lot of goods, such as cars, computer chips, computers, etc. And so with that normalization, we should see the supply chain allowing for more goods to get back on the market, which should continue to lower inflation expectations on the goods side. Now, companies are still going to need to cut costs if they do see slower growth economically. And so job cuts are likely to continue throughout 2023. We've already seen quite a number of companies announce that they're cutting jobs here into the end of 2022. And that's really going to be based off of their economic growth projections. So if the consumer demand continues to slow, we're likely to see job cuts continue as well. That said, companies have also mentioned that they've taken so much time and spent so many resources to get those jobs filled that they're unlikely or unwilling to slash jobs across the board without consideration. So it's likely to be more of a scalpel-based approach from a corporate standpoint in order to get that headcount lower so that costs come in line with what they need for their expectations. Now, alongside all of this, we have mentioned in the past the US dollar has been really strong throughout the year as our interest rates have increased. Well, if we believe interest rates are going to decrease in 2023, the US dollar is likely going to weaken a little bit, which for companies who are multinational and they get money from other countries denominated in other currencies, that actually is a tailwind for United States-based multinational companies. So we do believe that a weakening US dollar should actually help bolster corporate profits throughout 2023. Multiples, meanwhile, and we've mentioned multiples in the past as a gauge of sentiment on the market. This is a valuation methodology, and within the stock market today, the S&P 500, the current multiple on earnings is about 17. And we think that's a fair value. In fact, over the last 20 years, it's about average for the S&P 500. It was as high as 22 or 23 in 2001, which is very elevated. But we think multiples are going to stabilize, maybe a little bit lower, depending on where growth comes in throughout 2023. And with that stability, that actually should help provide stability to the overall market, assuming corporate earnings remain relatively stable as well. And so going into 2023, we do believe earnings are likely to fall just a little bit as these companies work through some of the growth headwinds that we do forecast for the new year. But as restrictive policy headwinds turn into tailwinds, if we do see rates begin to get cut throughout the end of the year or the beginning of 2024, we do think that corporations are going to be on a relatively good foundation after they've cut costs, reduced headcount, and allow themselves to leverage that foundation going forward in 2024. And we did mention demand from the consumer standpoint. We do believe that is going to soften. In fact, we have seen some softening already around retail sales here throughout the holiday season. Some of that savings is getting drawn down, and some of the job losses that we've seen thus far are likely to weigh on consumer sentiment. Real wage growth as well has started to soften. And what that means is you have wage growth in the form of, some inflation. People are getting paid more to work, but inflation offsets that. And as we see inflation continuing to offset that, the dollars that go into consumers' pockets feel like they don't have as much spending power as what they would have otherwise if inflation weren't a factor. And even though we do think inflation is going to come down throughout 2023, even though it's coming down from 8 to 6 is still a high number. We hope that it gets lower throughout 2023, and so does the Federal Reserve. So even if it's at 5 or maybe even 4, that's still a lot higher than 2. And so we do believe inflation is going to continue to weigh on that growth throughout 2023, albeit inflation going down in the right direction, perhaps elevate sentiment a little bit as a result. We mentioned goods demand earlier coming down. We think services demand is going to continue to trend down as well. However, that is a more stickier category. It's harder for our services-based economy to have fewer dollars go in that direction. So that's really going to be a key point here throughout 2023. If we can see services demand fall as well, the Federal Reserve will get comfortable with cutting rates to a more accommodative level in 2024 and beyond. Now, households do still remain in good shape because of all that COVID savings that people have accumulated over the last couple of years. JP Morgan estimates that there's about $1.2 to $1.8 trillion of excess savings on consumers' balance sheets. So even though we do have a higher inflation economy and perhaps a slower growth economy with fewer jobs getting filled, consumers still seem to be in good shape and may be able to weather that economic storm a little bit better had they not had this savings. And so despite some of these negative wealth effects, real wage growth slowing, perhaps home prices coming down or at least not growing as much because interest rates are so high, we do believe consumers are likely to remain stable throughout 2023 and into 2024. But that's going to largely be a function of inflation coming down and the Federal Reserve becoming more accommodative towards the tail end of 2023. Now, what do we think the odds of all these things happening are? Well, our base case here in the middle, we think it's about 60%, meaning that it's a little bit better than a coin flip chance of happening. And everything that I described before, modestly lower yields, economic growth moderating, slowing a little bit, but moderating, unemployment slightly higher to bring inflation down, and then consumer spending some of the excess COVID savings and corporate earnings stable but lower. We do believe that it would account for a soft landing if this were to occur, and it seems like the stage is set well for that to occur. Now, what if that doesn't happen? Well, our bear case or a downside case, we believe there's about a 25% chance of that happening. And what that would be made up of is growth slowing significantly more than what we anticipate, inflation staying sticky at a higher level, which would cause the Federal Reserve to perhaps take a more aggressive stance and increase rates further above that 5% target level that they've currently set out for themselves, which would also kind of halt consumer spending because jobs are likely to go away faster. Inflation's higher, therefore all that excess savings goes quicker. And so that would be a hard landing. That would be a recessionary environment that would take us a little bit longer to get out of. Again, we don't think that there's as likely of a chance of that happening as our base case. And again, it's all going to be dependent on inflation moderating over time and hopefully the Federal Reserve becoming more accommodative as a result. Now, on the upside, we do believe that there is a chance of something better than a soft landing happening. And we put that chance at about 15%. And really what that would be comprised of is inflation coming down a lot quicker than what we anticipate, really over the winter months here, but into the beginning of 2023. We think treasury rates or government bonds, the yields on those bonds would come in lower, which means the Federal Reserve, their rates would have to become lower. And corporate earnings would be more robust because with all those yields coming back down, it means that their borrowing power becomes elevated and they may be able to spend a little bit more on projects or hiring, which means consumer wealth would expand. So we do think that there is a chance of that happening, albeit a relatively unlikely one, because we do see that the Federal Reserve is forecasting higher rates for longer. But at the end of the day, even if we do experience a recession in our base case, we do believe it would be a relatively shallow one and one that we could rebound from in 2024 and beyond. So that's our 2023 outlook. If you have any questions, please feel free to reach out. We're always happy to answer those questions for you. Hope you have a safe and happy rest of 2023 or 2022, and we'll see you in 2023.